Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I've got two paper money trades for you today on two high-profile names. We'll look at Palantir, that is still moving, still in the news every day, a highly watched stock, and then Boeing, a little bit of headline news today in that name. So let's get to our first trade of the day, and that is Palantir. Now, if you look at the implied volatility on Palantir, it's sitting around the 72nd percentile. The stock has earnings coming up May 5th, so still a ways away on that one. But what we looked at here, because of the high implied volatility, is we looked at something in the short Vega category, which is a short put vertical. Went out to the May 2nd expiration. So I gave myself a little time, 17 days till expiration and ahead of the earnings event. I looked at a short put vertical, selling the 85 put, buying the 75 put, both in the May 2nd, collecting, I put it in about $1.70 credit. It's about $1.45, $1.50 credit right now, in that range. This is, remember, the risk on this trade is the width of the strikes, in this case $10, minus whatever credits you take in. So if you collect 170, it's $830. If you collect 1.5, it's $850, right? The max you can make on this is the credit taken in. That's the difference between the short vertical and the long vertical. If you're selling vertical spreads, you get the higher level of probability of success, but you collect less, and the risk outweighs the reward. So there's always the trade-off that we talk about there. The risk on the trade, $10 strike minus whatever credit you take in, and the maximum profit is the credit taken in. The break even, it's that short strike, in this case the 85 strike, minus the credit. So if it's $1.70, it's $83.30 would be your break even. If it's $1.50, 83.5. You get the math there, right? So there's our first trade in Palantir. Our second trade, Boeing. Now Boeing, that has earnings coming up sooner. April 23rd is when they come out with their earnings report. So this is also in the news today with some China news. By the way, China government has not confirmed any of those cancellations of deliveries of Boeing planes. It's a Bloomberg article, but not confirmed yet from China. Make sure we understand that. So on that, I went out to the May 9th, so past the earnings date of April 23rd. I went out till May 9th, bought the 155 call. Then I went into this week and sold the 162.5 call. That is pretty much in line with the expected move between now and just the end of the week. Remember, it's a holiday shortened week, so only 2.5 trading days to go. So bought the 155, sold the 162.5 in this week. The debit there, I put in about 870. It's trading about 860 right now. And so this is another discussion topic. Because we've gone out to the May 9th expiration, which is 24 days out, we're paying a bigger premium for those further out options. So therefore, an 870 or 860 debit is bigger than, more expensive than the width of the strike. So this is something you have to be cognizant of. Because why? Because you can extend duration and chip away at that net debit, but right now you're buying that for more. So there would be a small amount of risk on the upside here because you've done that. So anyway, the risk on this trade is the debit paid. You're looking for a move this week, 2.5 trading days, up to the 162.5 level. And both of these trades are bullish in nature. A short put vertical is bullish. A long call diagonal is bullish. So look at both of them in a bullish posture. That's our show for today, everyone. We'll see you tomorrow with another edition of the Daily Trader. I'm Kevin Hincks.